That we've had out this morning. I'll start in Anna's favourite sector, cement. Holcim results out this morning saying that they expect the profit to increase this year. They're seeing growing pressure on the building sector globally to decarbonise, but that boosting demand for their sustainable products. Also looking at BASF out of Germany, expecting roughly flat earnings this year, and Swiss Re in insurance out of Switzerland announcing a share buyback and increased full-year profit. So just a few more stocks to keep on our radar this morning, Anna, as we inch towards the market open.
Yes, edging towards the market open. I take it entirely as a compliment that everybody thinks I'm obsessed with the real economy and keeping my feet firmly on the ground. Let us have a look how these European equity markets open up then this Friday morning. The FTSE 100 out of the gates with a little bit of upside. Maybe that is all we get this morning, up by 1.2%. The STOXX 600 as a whole then pretty flat. We don't have a huge amount of important data points coming through. We haven't had this week. Next week starts to look a little busier. Certainly the non-farm payrolls looms on Friday, and we're starting to see options pricing around that. So the market is starting to think ahead to that macro theme a little later on. We're also gearing up for a weekend where we'll watch the news flow with regard to Iran very closely, of course. The CAC 40 then down by 0.1%. The IBEX down by 0.25%. Tom, do you see anything exciting in the sector's picture?
Top of the list in terms of your sectors, basic resources up 2%. You're seeing gold prices higher. Copper is higher by 1%, a little over 1% so far in the session. So that's feeding into the basic resources. Modest optimism is coming through. Top of your list in terms of sectors. Tech, interestingly, is up 0.2%. On the downside, utilities, typically, of course, a safe haven, currently the biggest loser on a sector-by-sector basis, down 0.7%, followed by media, travel and leisure down 0.5%. That is the sector breakdown. Most sectors in negative territory so far, but of course we continue to see the pricing reflect. Lizzie.
Well, I'm just focusing on those earnings stories that I had highlighted earlier. A few of them still waiting to open, but IAG shares down 0.4%. Rightmove up nearly 5%. I spend a lot of time on that website, waste a lot of my time, but Rightmove there, despite all of the AI worries that we've been talking about, a nice performance there this morning from Rightmove. I've also got an eye on the gambling stocks, because you had that Flutter tepid US forecast. So I've got an eye on Entain. Those shares down 2.8% at the open.
Yeah, absolutely. And Flutter yet to open. So we'll keep an eye on that one. And that was a sector that was doing really well yesterday. So we'll see what's happening there. Let's talk about the broader markets then and asset allocation right now. HSBC strategists have cut their US equity overweight in half, rotating some of that allocation into emerging markets and to Europe amid strong economic momentum. The team, led by Max Kettner, remains firmly risk-on, citing an increase in key cyclical indicators such as spending and manufacturing in the last 2 months. Max joins us now, Chief Multi-Asset Strategist at HSBC. I hope that was all correct, what I said there.
That was very correct.
Okay,
I
good.
looked at it and was like, wow, did I write that?
It always makes me slightly nervous talking about a person when the person is sitting next to me. So that's good. I'm glad that was all correct. So tell us a little about what is animating you about Europe and making you dial back exposure in the States.
Well, it's 8 a.m. There's very little that animates me at 8 a.m., to be honest. You know, when you guys were saying, does Tom see anything interesting, I thought you'd introduce me, and I was like, wow, that's already sad if I'm the interesting thing, but luckily that's not the case. No, what's animating us on that is, I think we're talking probably a little bit too much about AI, right? The story of, obviously, this week was this Citrini Substack, and we're talking about, is AI disinflationary? Is it inflationary? What's the future in 5 years or 5 to 10 years going to look like under AI? You know, what's the next trades? You just said, right, we had a sector yesterday that was up, now it's down the most. So we have this really weird environment where day by day is a new trend. And every morning you wake up and it's like, right, what's going to be the topic du jour today? And I think we're probably missing that under the hood, there is some proper cyclical recovery going on, right? You look at PMIs, just simple PMIs, or you look at new orders over inventories, you look at the most open, the most manufacturing-driven economies, look at Sweden, Taiwan, Korea, you know, the likes of even the Netherlands, Czech, right? The really open, the smaller, the manufacturing-driven economies, all of them actually have been starting to see a real pickup in the last 2 months. And that's, I think, what's a little underappreciated, particularly by US rates now. I think we're pricing a little bit too much of this.
Yeah.
Oh my God, AI is going to be disinflationary already now, and we're going to see, we'll have to see even more rate cuts now immediately because of AI disinflation. And we're ignoring that under the hood, there is a sort of proper textbook style cyclical recovery.
Okay, so that's all positive. But how much of that is that you mentioned some European countries, you also mentioned some in Asia, and we've got the MSCI Asia Pacific, I think, having its best February ever, or since the records began, 1998, many years ago. So that's all really good for Asia. Is it as good for Europe? Can it be as good for Europe, or is Asia going to lead on this?
I think it is. I think for Europe, you know, it depends on what sectors you're looking at, right? Is that really the sort of all go really into and the all clear for the autos, for the chemicals? I'm not sure. But if you look at the likes of the banks, right, SX7E, I mean, you're really just along the level of the yield curve. So even if the yield curve just stays where it is, if it doesn't steepen much further, even if it does that, and it just stays as steep as it is, you know, that's really good for the mostly retail and corporate-driven banks. If you look at industrials, look at SXNP, you know, you've got your cap goods in there, so if manufacturing does pick up, you're long that theme. You've got your infrastructure names in there, so if we do see a positive surprise from, let's say, German infrastructure stimulus, maybe some of the order books going up, you're long that. You've got the defense names in there, right? So you've got some sort of geopolitical hedge in there. So frankly, there's, like, you look at the industrials in particular and the industrial goods and services in Europe, you're long a couple of themes with just being long one sector. That's really positive.
Max, banks, industrials, infrastructure, defence, they're quite consensus. Does that worry you?
No, because I think when we look at the earnings side of things, right, and the earnings upgrades of things, side of things, I think that is still going so strong, and particularly I think on the industrial side, where I would be worried is if I say, right, I'm just going to go long defence. I'm just playing this, right? Because I know that, you know, something in geopolitics will flare up, and therefore, you know, I want to be only long that theme. That's, I think, where I'd be a bit more cautious, right? But the good thing, again, right, with industrials, you're not just long defense, you're long the cap goods, you're long the, you know, the infrastructure theme as well. So you're long the miners as well, right? The metals and mining is in there as well. So if we do see some supply-driven uptick in metals prices as well, you're long that as well. So to me, I don't think it is, it's an issue to be a consensus there, because you're long so many themes in just one sector that actually, yeah, if one of them, let's say if defense doesn't work anymore for a couple of weeks, something else might pick up. The miners might be picking up because metals prices go up.
Just help me understand the thesis around the US then and cutting that exposure, because we had the Fed expected to cut another 2 times. That's the market price. And you've got the fiscal stimulus, the tax cuts coming through. You've got the lead up to the midterm elections. You've got David Sachs, who's the AI czar to President Trump, saying you could see 4, 5, 6% growth in 2026. What happened to that?
So to me, we were 50% equities overweight in the US and 50 outside of the US. And now it's sort of 25-75. Right? It's not like we're, oh God, I'm so bearish US now. It's just that where do I, if I see under the hood that cyclical uptick in growth now happening, where do I want to play that best? Is that really played best in the US, in industrials, or is it played best maybe in Europe? Again, where you look at the industrials and you long multiple themes. You know, you go into emerging markets, you go into maybe something like Brazil, like LATAM, right, where you long the materials, the energy, the financials, if you look at Brazil, right, where it's a much cleaner cyclical, much cleaner value exposure compared to if I just go long the US now. And the issue, I guess, in the US as well is that the cyclicals have rallied already quite a bit, right? Whereas there, it's probably tougher to get the same kind of exposure. I do think when you look at in the US, you look at what we call the lower end of the K-shaped sectors. Think your transport, your US retail, XRT, your home builders, XHB, right? Like all those, I think really you want to go long the cyclicals in the US, but really the ones that are most likely going to benefit from now the pass-through of that OBBB stimulus in the next couple of months.
Okay, Max, I'm going to ask you my questions in just a minute. Hold that thought. Max Kettner, Chief Multi-Asset Strategist at HSBC, will be back with us shortly. But coming up on the programme, British Airways owner IAG reporting fourth quarter revenue that missed estimates. And we're going to hear from the CEO, Luis Gallego. That interview next. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazla Amin in Davos, Switzerland, and this is Bloomberg.
Welcome back. This is the opening trade. 11 minutes past 8, 11 minutes into our trading session. Pretty flat at the overall market level for European stocks this morning, up by 0.1% on the Stoxx 600. Basic resources doing pretty well, and we have some movement higher in some of the commodity prices, the likes of silver, for example, and that seems to be helping that sector. Real estate also a gainer to the downside. Media, travel and leisure also weaker. A lot of that has to do with the leisure side, though, the gaming side, where we see a bit of weakness. But aviation also in focus, Lizzie.
Yes, turning back to earnings this morning, British Airways owner IAG reporting revenue for the fourth quarter that missed the average analyst estimate and announced another €1.5 billion share buyback. Joining us now is the CEO of International Airlines Group, Luis Gallego. Luis, thank you so much for making time for us this morning. So you've got a chunky buyback here, but also you're looking at a rebound in transatlantic travel. Just talk us about how the geopolitical tensions and the tariff uncertainty might affect that rebound in travel.
Good morning. So thank you for having me today here. I think we have seen since the third quarter of last year a rebound in the North Atlantic demand. We have seen, in particular in the case of VA, a strong premium leisure demand that we didn't have before, and also the non-premium leisure is working well. So US point of sale is recovering. Business traffic is also strong, both point of sale UK and point of sale US. So we are positive about the demand this year in North Atlantic.
What risk do you see going forward then? What's your big message to shareholders this quarter?
No, I think the message is that we had very strong results in 2025. We are delivering what we promised. We did it even before that we said to the market previously. The demand that we see for this year continues strong. As I said, business traffic continues coming back. Latin America is also another market that is performing very well. So positive outlook. The first half is of the year is on plan. So we are positive.
Luis, good morning. Are you still seeing more demand then for the front end of the plane, the business class flights, versus the back end, the economy seats? And does that continue in 2026? How is that picture shaping up?
No, yes. As I said, business traffic is coming back. That's important for us. The profile of the bookings is different because usually business traffic they book late. But the non-premium cabin are performing better than they were performing in the third quarter of last year, and we continue with a strong premium leisure demand. So in general, we have a positive view for the year.
And specifically, you talked about that important transatlantic route, specifically for BA. Can you give us a bit more granularity in terms of how you think that demand picture evolves through 2026? You're seeing an uptick. How confident are you that you continue to see demand there, and kind of what metrics are you and the team looking at?
No, when we see what we have booked for the first quarter, we have a lot of certainty of what is happening. Second quarter and third quarter, the visibility that we have is only 30% book. So, but with that information that we have today, what we see is that, as I said before, we are on plan. Business traffic is coming, and we continue with a strong premium leisure demand. So I think we are in good shape.
Just one more question on the transatlantic, Luis, and then I promise we will move on to other topics. But I'm intrigued because you talked about lots of different bits doing well. What about the UK end of the transatlantic routes, or maybe even the wider European willingness or desire in the leisure cabin to go to the United States? Did that dip, and is it still reduced, or has it bounced back?
No, I think the UK, for example, business point of sale in UK is working very well. We see that for the summer, London market is reducing a little, but we are offsetting that with a lot of transfer traffic to other regions in Europe, in particular to the south.
Luis, I was speaking to your CFO, Nicholas Cadbury, last year, and we were talking about the TAP deal. He said that you would only want a majority ownership situation. How are negotiations going? Are you getting what you want?
Sorry, you asked about TAP?
Yes.
Yes, sorry. No, yes, in the TAP, you know, we are in the process, but we have a model in the group that we want to manage the assets that we have, the different airlines that we have, and that's something we are talking with the government to see if there is an opportunity to do that. So we need to take a decision if we go ahead or not. We have until April to present a non-binding offer, and that's what we are considering now.
Can I ask you about oil prices, Luis? I mean, a lot of focus on geopolitics, of course, and you know, none of us have complete visibility as to what happens there. With that in mind, how are you hedging oil at this point?
Yes, we have a policy that we changed after COVID, that we hedge the next 2 years. For sure, we hedge more the next 2 quarters. But we follow that policy. We are in a very volatile environment, but we are confident that with this hedging policy, we can have certainty about what we are going to have this year.
Okay, Luis Gallego, CEO of International Airlines Group. Thank you very much indeed for your time on the back of those results. Talking of corporate news, we have a redhead crossing the terminal right now. This is in the deal space around data centres. And this is Canada's Pension Plan Investment Board, the Canada Pension Plan Investment Board, teaming up with Equinix, the data centre provider, to acquire atNorth Holdings. That's a pan-Nordic data centre operator owned by Partners Group Holding, based over in Iceland. They have data centres in Iceland, Denmark, Sweden, the Nordics, basically Finland as well. So that is a, $4 billion deal. We're going to be speaking to Regina Dahlstrom, the managing director at Equinix, for an exclusive conversation about that deal. That's at 8:45 a.m. London time. A lot of questions on the data center space, particularly, of course, that demand coming through from AI and hyperscalers.
Let's check in on the Core 6 this morning, how they're holding up as we start this Friday morning. We have, of course, the likes of Rheinmetall and Novo Nordisk, LVMH, ASML here. A mixed bag, really. The underperformer seems to be LVMH this Friday morning. But let's dive into the individual stocks on the move with Charlie Wells.
Good morning, Lizzie. So it's a Friday, and I know people are going to start thinking about real estate. I do on the weekend because I start thinking about where I want to live. Let's talk about Rightmove. They are up 4.3%. They had a really solid earnings report. They've got a return to shareholders as well. Also in the backdrop of a property market that is looking like it's turning a corner here in the UK. That's on the residential side. Let's take a look at Merlin, which is on the commercial side, and they are doing fairly well as well. They also had a pretty solid report, up over 4% in that commercial real estate space. Now, there's been a really interesting, different story moving out of real estate and into online sports betting. This has been a space where there's been a lot of excitement, but there's also been a lot of competition. You can take a look at Flutter Entertainment. So they are dual listed here in London, but also in New York. They put out a tepid forecast yesterday for the United States, down over 10% this morning. So a lot of pressure there as the markets start to open and start to digest that forecast. Let's take a look at another stock that is down this morning. That is Teleperformance. That is the French outsourcing company. They provide a lot of that kind of customer support that you get, down about 8% this morning. If you think about customer support, you start to think about AI, don't you? Because that is a technology that's really starting to compete here. They were talking about some leadership changes. So again, under pressure this morning. And let's end with a German chemicals company, BASF. That has also been a space that's been under a lot of pressure. The continent really is, the world is really awash in chemicals, as they say, down about 2%. They said they're going to have a pretty soft year, pretty tepid, as they face a lot of competition and that supply of chemicals in the industry.
Charlie Wells, thank you very much indeed on some of the stocks, the individual names on the move this Friday. Let's bring back in Max Kettner, Chief Multi-Asset Strategist at HSBC, who has been very well behaved and sitting, which is unusual for Max Kettner.
You sound surprised.
I am surprised, sitting patiently.
This is about the longest 10 minutes I've ever sat on a chair.
No, well done. Yes, you remind me of some of the toddler kids that hang out with my own children. Max, thank you for your time.
Thank you very
much. Let's go back to the markets. Look, there is a bit of angst. We're seeing that in terms of the private credit space, the cockroaches, and we're seeing kind of day in, day out, there seems to be another story, more spotlight on some of these private credit lenders and some of the tensions, some of the cracks, some of the fissures. Do you worry about contagion risks?
Not really. It depends on how much you're asking me to worry. Is there going to be, or am I worried to the point that, is this like 2007, 2008? Yes. Is that like a systemic crisis? No, I'm not going to give you that headline, right? No.
Why?
Because the point is, right? Why? I don't. I guess.
Why not the headline? Why are you a little bit more sanguine?
A bit more sanguine, right? So look, I think when you look at actually on an index level relative to or compared to the cockroaches stories, that tells you a different story. You know, let's be very honest. The way you get people scared is by saying First Brands, Tricolor, Blue Owl, right? You give them the single name stories. The way you don't get people scared is to say, look, if it's going to be systemic, we're going to have to look at the aggregate numbers, right? Because it's not like 1 or 2 or 3 single name stories. Because let's be honest, there is always some single name stories. They come and go, right? Once a month or once every 2-3 months, right? And then people forget about them. But let's say when we go back to First Brands and Tricolor, who still talks about that? No one. And in November it was like, oh, this is how it started in 2007. And we had numerous of those examples since COVID. But if you look at an aggregate basis, you look at private credit delinquencies, you look at bank loan delinquencies, you look even at public credit and public high yield delinquencies, they've all been going down in the last year and a quarter, the last sort of 15 months. They've actually started to trend down. If you had asked me sort of summer 2024, the lines were doing this. Now, obviously, I would have said, yeah, I don't think it's going to be that bad. But in actuality, I wouldn't really have had a proper answer why I think that is the case. Maybe because rate cuts, but actually what we are really clearly now seeing is the effect of rate cuts, that lagged effect of rate cuts is now coming through in the delinquencies. Look at private households. Even credit card delinquencies are starting to go down. So on an aggregate basis, things are actually starting to be better. That's number one. Number two, very quickly, is if you look at private credit, the absolute growth in the last particularly 5 years, phenomenal, but we're coming off a base that's extremely low. Bear in mind that if you look at the total volume of private credit relative to bank loans, just in the US, is 3%. Right? So 3% private credit relative to total bank loans. That's not big enough to create a big sort of systemic issue.
But is it a selling point for Europe that it doesn't have as much exposure to tech?
No, I don't think so, because you look at Europe, again, do I want to lean into that right now because it's got more cyclicality? Yes, right? Do maybe some of the private credit or private markets names, do some of them have an issue because they have more software exposure, and in that software exposure there might be some issues lurking? Yeah, maybe. I'm not a single name analyst, right? But what you're seeing right now is when you look at the software sector, it's been sold off indiscriminately, right? You look at the components and every single one has been down. So essentially it was like, if you're a software, you're going to be dead. And that is too much. There are some companies, right? If you look at IGVs, there are some companies in there that are literally running a monopoly-style business model. Yeah. That's too much to not have any sort of differentiation between them.
So, Max, when we see news reports, and we might get more of these, to your point about, we keep hitting people with these individual company stories. So when we get more stories of BDCs, these are the business development companies that do direct lending to software companies, and we'll see more of them reducing payouts to their owners or decreasing the value of their portfolios, especially if they've got lots of software exposure. Do we just put that in a bucket and say, well, that's interesting, just in the same sense that corporate earnings are interesting, but it's not a canary in a coal mine?
I don't think it's a canary in the coal mine. No, again, because the total volume is too small to really create the systemic issue. That's one. Two is, I think it's probably a sector-specific thing. Is that something that will flow through into the big banks, the regional banks? No, not really. In fact, look at the regional banks. Look at KRE over the last 3-4 months. It's been massively outperforming. Right? And rightly so, because people are now saying, hey, you hold on, like, actually, is that something that will flow through into the banking system more widely? No, it's too small to matter. And in fact, we are starting to see, not only on the private household side, not only delinquencies, credit card delinquencies and all that going down, but you're also starting to see on the household and on the consumption side, you're clearly starting to see that the lower end of the K is starting to do better. If you look at private household consumption, the low-income earners are starting to actually have consumption a bit more up. And that is what's probably a little bit more important for the wider banking sector overall, where it's a bit insulated then from the BDCs and all that.
Max, thank you very much. Thank you for your time. Max Kettner, Chief Multi-Asset Strategist at HSBC. Coming up on the programme, we'll return to the corporate earnings stories. The autos component manufacturer Valeo reported earnings this morning. We'll be speaking to the CEO, Christophe Perriat. We'll talk about Chinese competition, perhaps, and the state of the European car industry. That interview is next. This is Bloomberg.
climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Happy Friday, everybody. This is the opening trade. We're 30 minutes into today's session, and this is the picture in European stocks this morning. Pretty tepid, actually, in the open. We're having weakness in Paris, but the outperformer this morning is the FTSE 100. That corresponds with the sectoral picture. We've got basic resources leading the gains, and copper set for a second weekly gain at the moment. This, in contrast to the US futures picture, a little more negativity set to come out stateside. Later, of course, we've got those US PPI numbers dropping this afternoon, London time. But Tom, what are you watching under the sectoral?
Yeah, look, Lizzie, to your point, it does feel like a European equity market that is looking for the next catalyst, but within the context that we're still close to those record highs. So volumes versus the 28-day average, a little bit higher in the Friday session today, up about 5% versus, again, that 20-day average. In terms of the breakdown, in terms of the members on the upside versus the downside, you talked about basic resources as a sector. That was the number that we were looking at. In terms of the breakdown, individual names, Siemens Energy is gaining 1.5%. It's got that exposure, of course, to data centres, and they're going to be paying a dividend of 70 euros per share. In the medical space, Roche gaining 0.7%. Swiss Med approving Roche's treatment for lupus, so that's lifting that stock, it seems. In the mining space, it's interesting, you've seen a pop up again in terms of copper and silver in the session today. Glencore is gaining on the back of that. Broadly, you're seeing a lift for the mining space on the back of copper prices and silver. On the downside, it's the exposure for banks, and particularly the likes of Jefferies, Santander, and here in the UK, Barclays, to that collapsed UK lender MFS. So Barclays down 1% on that exposure, potentially $400 million or thereabouts. Teleperformance, this is potential hit on the AI story. They had softer first quarter forecasts. They're looking at revamping the leadership, down 7% there over in France. So that is a pressure point, certainly in terms of the tech space. BASF, major chemicals maker, has major exposure to China, based, of course, in Germany. Results showing that there is cost-cutting. There is that chemical slump that continues. Price pressures, of course. The energy component is a challenge for BASF, currently down 1.6%. Anna, what else are we thinking about?
Yeah, let's turn our attention to some geopolitical news themes this morning. Pakistan's defense minister has declared, quote, open war with Afghanistan after both sides carried out cross-border strikes overnight that killed dozens. Tensions have steadily risen between the neighbours since the return of the Afghan Taliban to power in 2021, with Islamabad blaming Kabul for hosting militant groups that plan attacks in Pakistan. The Taliban denied the accusation. Prime Minister Keir Starmer's ruling Labour Party has lost a formerly safe seat in the UK Parliament, finishing third behind the Green Party and Reform UK. The Green Party won the special election for the Manchester seat, with candidate Hannah Spencer securing 41% of the vote. Netflix has dropped out of the battle to buy Warner Brothers, clearing the way for Paramount to clinch its $111 billion deal for the historic Hollywood studio. Netflix said that while it believed its deal would have passed muster with regulators and created shareholder value, it didn't want to keep on bidding. Tom.
Let's get back to the earnings space right now and focus in on autos and that sector. Autos component manufacturer Valleo's fourth quarter revenue beat estimates as the company engaged with its cost reduction plan. The French car parts supplier's full-year sales came in at just shy of 21 billion euros. Very pleased to say we're joined now by the company's CEO, Christophe Barilla. Christophe, good morning. What should investors take from these numbers and these earnings, and how it positions the company going forward in a sector that, of course, has been challenged?
Well, for sure, the sector is challenged. Good morning to all of you. I think it's a very solid result. In 25, the sales are up like for like, the operating margin is up, the free cash flow generation is up, the net result is up. So, I mean, it's another step of improvement of Valeo. We have done this, since 22. We are delivering what we are promising, and on top of that, we have issued a positive guidance for 26. Stating that we will continue to make progress in 26 on profitability and cash generation. So overall, it's a solid year, and it's a year where we are continuing to make sure that the years to come are going to be okay, because we have good order intake, good orders that we receive from our customers.
Christophe, the China market is still underperforming for you. When does that turn around?
It's going to turn around in H2 of 2026, where we are expecting growth to come back. And then we plan to outperform the market as of, the following year. China for sure is a very important market, as you know. It's an important market for Valeo as well. We have 50% of our sales there. We are a strong supplier there. Competition is strong, but we have the competitiveness, we have the technology. And, one of the most important number, I think, in our release yesterday was the amount of orders we are receiving in China for the Chinese OEM. In 25, it was, in total worth 2.8 times our sales. So we are going to grow again in China with the right customers, with the Chinese OEMs, and there are proof points of that in the orders we received from these customers last year.
Christophe, good morning, it's Lizzie. What are your thoughts around chip availability this year? Some are warning that you could be pushed further back in the queue because of the need for chips for data centres. How are you planning around that when it comes to EVs and software-defined vehicles, which of course need chips?
Well, the subject is really on memories, where there's a competition between all the industries, the consumer industry, the auto industry, and the data center industry. What we're hearing from, the memory suppliers is that, they're going to protect the auto industry. This is what they said, and I think it's linked to the way, the auto industry is giving good forecast and reliable forecast and stable forecast to these suppliers. So this is what we are hearing from them. Of course, it's a day-to-day battle to make sure that we have the right quantities. We're working with our customers, working with, our suppliers, and let's see what happens next.
And how are you planning more generally around heightened geopolitical risk?
Well, probably the best way of handling them is to have, a local for local strategy. And this strategy has been helping us, for instance, to navigate through the different tariffs that have been implemented here or there. We are North America. We are a North American supplier in North America. We are a Chinese supplier in China. We are a European supplier in Europe. We are operating where our markets are. And, when there's so many Forex variations, geopolitical, issues, I think this is a very strong protection for our operations.
Good morning to you, Christoph. I wanted to ask about the European side of things and whether you have any expectation or think it's important that in Europe, that European companies have some pressure on them, I suppose, to use European suppliers. Is that something that you're expecting European regulators? The EU is considering adopting some kind of rules around European preference. Is that something that you would welcome?
For sure, we are a promoter of this idea for a very simple reason. I mean, let me remind you, and I said it before, that we are very strong in China, and China is the main country of value. But we are doing in China, we are manufacturing in China what we sell in China, and we believe that's the right thing to do. We don't intend and we don't want, to produce in China and then deliver to Europe, because this would be detrimental to the European economy and to the European jobs. Now, we have to, recognize that, China is 30% more competitive than Europe. This is just a fact. And we have as well to recognize that the, European auto industry is the main industry of Europe and worth 7% of GDP. So there's a real question, about, how to protect the European industry when it comes to the auto sector. And then you look around and you see that, in India, 80% of local content is required. You look at North America, 75% of local content is required. You look at China, 95% of local content was required. And that was not a requirement for Europe. So yes, I'm a promoter of a minimum level of European content on European cars at the level where it is today. Today, a European car has, in average, 75% local content. So it's the time now for, the policy makers to decide whether they want re-industrialization in Europe or delocalization outside of Europe. And let's see. I'm, optimistic about what's going to be decided. I think the next. The next step is going to be March 4th, where the European Commission will reveal its plan.
Okay, very interesting. The choice possibly facing the industry and regulators in Europe. Christoph Breuer on the results, of course, CEO of Valeo. Those earnings coming in broadly in line with expectations. Stock down about 2% so far in the session. Coming up, we were talking there about the chip shortage. Researcher IDC says the global smartphone market, ties in, will contract this year, but by how much? It's quite startling. The answers when we come back. This is Bloomberg.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks happening everywhere, and that's what AI is most helpful in improving.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Before the break, we asked, by how much does researcher IDC see the global smartphone market shrinking this year? The answer is 13%. The researcher says this is due to the unprecedented memory chip shortage, marking what it calls, quote, a crisis like no other. IDC now sees just over 1.1 billion mobile shipments this year. That is down from 1.26 billion, almost 1.3 billion in 2025. It says memory chip shortages have made cheap phones a thing of the past. Premium handsets, like the bulk of Apple's iPhone lineup, will weather the crisis better, they say, though companies like Xiaomi and Lenovo have warned that consumer prices may have to rise. It is therefore unlikely to impact Anna Edwards' gold and diamond bezel-edged iPhone 17, Anna.
That's definitely the way I roll, Tom. But it does tie into the conversation we were just having, doesn't it, Lizzie? Because we were talking to Valeo about chips for cars. And if chips, there's just a lot of competition for chips, and everyone's having to pay more for them. And what does that mean for the car sector? He said that their supply is going to be protected, but you know, when we speak to lots of different sectors that need their chips, they all say they have good relationships with these chip suppliers, and they are the ones who are going to get those chips. But lots of tech themes, including CoreWeave.
Yeah, do you know who buys a lot of chips? Yeah, CoreWeave. They buy a lot of NVIDIA's GPUs, and then they lease them out to the hyperscalers. So there was a bit of a shudder in the markets on the back of what CoreWeave was saying in terms of the capex it has to spend, coming in at 30 to 35 billion US dollars. The losses came in heavier. They're borrowing a lot more. What they're saying, CoreWeave, is that we see massive demand. We have to build for that, but clearly that comes at a price. And so that was one company that felt a bit of pressure. On the other side, Dell seeing some gains because of their exposure to data centers.
Is it just that they're at different stages? That you've got CoreWeave at the capex prove it stage and Dell at the ROI proved stage?
Different business models as well, aren't they? The different, you know, maybe different stages, but also different parts of that data center supply chain. And we're having really interesting conversations, sort of discovering where the money gets made.
Should we get more in terms of what's happening in data centers? And another angle on this, because some breaking news this morning was around what is happening with Equinix and the Canada Pension Plan Investment Board teaming up with Equinix and agreeing to acquire atNorth. That is a pan-Nordic data center operator owned by Partners Group Holding. The deal valuing the Iceland-based atNorth at $4 billion, including debt. Joining us now, very pleased to say, is Regina Dahlstrom, the Equinix Managing Director. Regina, good morning. Why does this deal make sense for Equinix?
This is about meeting the rapid growth of digital infrastructure need in the market. And combining the Equinix global interconnected platform with the high-density, high-capacity, IA-ready capacity in all 5 Nordic countries of atNorth is a magic combination. And I think we will have a very strong position meeting this market demand ahead.
And it means that you're essentially adding potentially eight data centers with more in the works as a result of this deal. What is the level of demand you're seeing right now, and how does it break down in terms of enterprise, AI, the hyperscalers? What is the demand picture looking like right now?
The demand picture is, like you say, it spans over all of those. So there's AI demand for sure, but underlying is still the digital transformation of our enterprise segment, which requires services to cater to sovereignty, security, resilience, and then in combination with the AI workload placements. That also, in their turn, needs connectivity. So I'd say it's a healthy mix of both, and they interact with each other and want to be placed nearby each other.
And Equinix, I should say, has enjoyed a bull run in the share price. Regina, good morning. So is it about, hence this M&A currency, is it more about organic growth from here, or have you got other targets in mind? Where else would you look maybe for the next acquisition?
No, I'm focused on the Nordic and framing this organic growth with the Nordic attributes. And I think we have a healthy pipeline to continue to build on our decades of growth in Equinix. And so we will. So looking ahead, we have 800 megawatts of capacity in the atNorth platform to start to work with when this deal is closed. And we will, and we foresee future decades of healthy growth ahead organically within Equinix.
I am interested why you see a competitive edge for Nordic data centres over other locations, and how the geopolitics feeds into all of this, because of course you've got the proximity to Russia. Do clients ask you about resilience on that front?
Definitely, and I'd say that the Nordics stands out more than ever in terms of being prepared and resilient. I think the attributes of the Nordics to its renewable energy, its sustainability agenda, and high degree of tech innovation stands out further. And then the preparedness and the resilience of the region has become more of a positive, I would say. Yes, there has definitely been highlights of the infrastructure in terms of the geopolitics, but I would say that the Nordics stand stronger than ever.
And it's also nice and cold, which possibly helps, Regina. Let me ask you about data center construction. We've seen anecdotally, or maybe more than anecdotally, reports that sometimes it's you can't build data centers fast enough in the States, sometimes because of a lack of workers or a lack of building materials rather than anything much more tech. How would you rate Europe's experience? What's been your experience watching the data center build out in Europe?
I think this is what's so impressive with atNorth, who have, in a very efficient manner, used, I would say, many of the benefits of the Nordics, the skilled workforce, the cooperation with local authorities, some power companies, and have done a fantastic job in building very quickly without compromising on quality, security, or sustainability. So I think, again, the Nordics, and in this case atNorth, really proves the point that you don't have to compromise on anything, building data centers in the Nordics, and deliver definitely the highest grade of all these attributes in terms of efficiency, sustainability, and quality.
Okay, so those attributes are at play in the Nordics. We've been talking a lot this morning, whether it's the car sector, the auto sector, or smartphones, about the lack of chips. I mean, particularly high bandwidth memory. And we know that a lot of that is going into data centers. Are you seeing, is that a constraint? What is the impact on your business? Are you seeing that impact?
So this would be our customers, and no, we don't see any indication of a demand, of less of a demand or anything similar. So no, from our point of view, our customers still seem to have ambitious plans of growth, and we have a healthy pipeline of our customers' demand into infrastructure capacity.
Regina, thank you very much. Thanks for joining us. Regina Dahlstrom, Equinix Managing Director. Thanks for giving us your time this morning. Let's widen our focus onto the broader markets. Adam Linton is with us from our Markets Live team. Adam, good morning. So one of the things that happened this morning, we got some French inflation data, and it came out a little stronger than expected, which kind of doesn't fit with the narrative that we've been talking about in Europe recently, that inflation, Europe doesn't have much of an inflation problem to worry about. It's pretty much, it's been at target. So this is just France. But we did see a little bit of a pop-up in the euro on the back of that. What are you thinking about the inflation picture?
Yeah, I think for France, a lot of that has been attributed to what we've seen in the energy markets. I think, it doesn't really change the broader picture of what we're seeing with the Eurozone inflation. It was particularly soft last month. It came in 30 basis points below the ECB target. And I think in terms of the broader ECB, conversation, we saw upgrades to inflation forecasts in December, which kept them in their good place, their happy place, and confident that rates will need to stay unchanged. But, I think there's a possibility that March we get a downgrade to some of those forecasts. And if we do, the conversation could then move on to the possibility of rate cuts. But I don't think that there's really alarm bells ringing in Frankfurt at the moment. Typically, when the ECB cuts rates, there's some sort of growth shock, there's some sort of financial distress, and we're just not seeing that at the moment. If anything, we're actually seeing the opposite. We saw those German PMI numbers last week. That was the first expansion, I think, since 2022. Potential for more to come, given the stimulus effects. I don't think there's really an argument, from a growth perspective or even an FX perspective. The euro's come off about, 2 handles since February, and even at the time, Lagarde wasn't really, concerned too much. So yes, there's scope to reprice more dovish direction, but not necessarily alarm bells yet.
Adam, how are you interpreting the market reaction, small as it may be, to the UK by-election result? I've got the pound in front of me up again by 0.1%, so nothing to write home about. And when you look at the gilt market reaction, really nothing when it comes to the 10-year, but the 2-year yield down a basis point. What do you read into what the markets are saying?
Yeah, I think the market's obviously clearly shrugging at it at this juncture. You have by-elections are lost by incumbent governments all the time. They have their own idiosyncrasies. But, with UK politics, there's not always necessarily an immediate reaction. We often see things cascade in UK politics. We saw that recently, the Mandelson affair. It kind of came out. Then we saw a few days later McSweeney resigned. Then we saw the Scottish leader calling Starmer to resign. And that's when we really saw the market get moving. So, be on watch for what happens in UK press this weekend, if anyone comes out and briefs against Starmer. But ultimately, I think a lot of commentators are more confident that May will be a more opportune time for any potential candidate to mount an attack on Starmer. And then at that point, that's when the market may need to begin pricing what comes next.
And it sounds like you think Reeves can pull off making the spring statement a non-event in the market.
I think so, yeah. The UK's finances are, shored up, but, not necessarily too surprising if you increase taxes on everyone. That is, not necessarily too surprising, but risks definitely remain ahead.
Adam Linton. Thank you very much indeed. From Bloomberg Markets Live team, of course. Have a great weekend. Adam, talking of the weekend, here's what else to be thinking about over Saturday and Sunday then, and to whet your appetite for some of the activities across Europe. The Milan Fashion Week is getting underway. Art on Ice, Zurich, whatever that is. Comic-Con London, Lizzie's going to be there with her best cosplay. And German football rivalry, Borussia Dortmund versus Bayern Munich. Oh, that's going to be good. And the Cricket World Cup as well. Interestingly, the Premier League is going to start streaming in Asia.
Yeah, in Singapore specifically.
Yes.
So, yes, but it's really a dramatic development, very small and contained. It's Singapore, not the world, but it is a really interesting test case, isn't it? There was no Premier League football on the weekend. There is plenty of it, of course. We didn't have it on the graphic, but this is a really interesting test case, because if they can go direct to consumer in Singapore, test it out there, work out what people will pay for it, and then see if they could do it elsewhere, that'll have lots of TV execs a bit nervous.
I always wonder if you're a TV or a rugby man, Tom. Guy's clearly a rugby man.
A TV or a rugby man?
Sorry, a football or a rugby man?
He doesn't
somewhere
want to
in
pick
between.
sides.
Yeah, I'm an Arsenal fan, and the World Cup, Rugby World Cup, I'll watch that. Yeah, the Six Nations gets my attention.
No rugby this weekend, though. No. So Mark Cudmore is bereft.
Yes,
Guy
he
is probably bereft wherever he is right now. He will not have the rugby to watch, which I'm sure.
There's the Cricket World Cup. There's the Milan Fashion Week.
And Andrea Felsted's in Milan for that.
Is she our fashion guru?
She's not taking you there, Izzy. I feel this is an oversight.
My time there has been and gone.
So there is no Rugby World Cup to watch. But instead, we offer you Bloomberg this weekend on Bloomberg TV. So this is a new show. David Gura, Christina Ruffini and Lisa Matteo. If you don't get enough of Bloomberg TV 5 days a week, then you now can tune in over the weekend. They'll bring you those conversations that could set you up, of course, for the following week in markets. Lots to watch and listen to, whether that's on Bloomberg TV or on radio. You can also access it on the Bloomberg Business app. There we go, promo done. Looks exciting. That is it for the opening trade. The Pulse is up next. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
It's deadline day in the safety dispute between the Pentagon and Anthropic, with the company's chief executive saying it cannot, quote, in good conscience, agree to the latest request. Now, Netflix says bidding war for Warner Brothers is no longer financially attractive, clearing the way for Paramount Skydance to clinch its $111 billion deal. Plus, a local plumber gives the UK Green Party its first by-election victory, increasing pressure on the British Prime Minister, whose Labour Party finished third behind Reform. So let me tell you, there's quite a lot going on in news, and then we continue looking at tariffs, trades, and of course the nuclear talks with Iran. S&P futures down 0.2%. If you look overall at what's, I guess, freaking out or certainly scaring investors, look, the disruptive potential of AI has definitely rattled U.S. equities for weeks, in what traders have dubbed the AI scare trade. And then there's a little bit of concern also about private credit because of a firm here in the UK. We'll get to that in a second. Brent crude 71.18. A couple of stocks, of course, that we're watching because of the big news that we had overnight. So Netflix, you can see gaining some 8.7%. Look, Netflix dropping this Warner Brothers bid, therefore leaving the way for Paramount to be the winner. And Netflix pre-market gaining some 8.7%. The other thing that we are looking at is Block. This is after Jack Dorsey's company decided to fire about 4,000 employees, almost half of its workforce. And this is a play on AI. So I'm not only looking at Block and thinking, okay, it's 23% higher, but I think it will probably send shockwaves, or people will start fearing for their jobs, and also CEOs will say, well, what does that mean for my workforce? And then finally, Dell gaining some 11.7% after Dell Project's AI server sales came in at $50 billion. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Anthropic has rejected the Pentagon's latest offer to defuse a standoff over the conditions that the company has sought governing the use of the AI software by the military. This escalates the standoff between the two parties ahead of a government deadline later today. Well, let's bring in Bloomberg's Washington Deputy Bureau Chief, Laura Davison. Laura, I mean, it's interesting because, you know, it's half basically about politics and half of it is about AI. So why is Anthropic opposed to the DoD over the use of its AI tech?
Yeah, so the Anthropic has said that the military shouldn't be able to use its Claude platform, its technology, to do surveillance of U.S. citizens as well as to conduct lethal strikes without human intervention. They say we don't know exactly how our platform would would go during these situations, and we just don't think it's safe. We can't in good conscience agree to that. The U.S. military has shot back and said, look, you know, we are the U.S. military. We should be able to decide how to make these platforms work. This is also, you know, kind of under the backdrop of that Anthropic has been one of the more left-leaning companies. The CEO supported Kamala Harris in the 2024 election, so there's definitely a political split here between the Trump administration and Anthropic as well. You know, this is, you know, kind of an issue that has really come to the fore, just bubbled up in the past couple weeks, and with Pete Hegseth and the Pentagon putting this deadline, 5:01 p.m. U.S. East Coast time, just about 13 hours from now, otherwise threatening to cut off potentially Anthropic from the U.S. military system. There's sort of an extreme option that they've thrown out that they could label it a supply chain risk, which would essentially remove it from all military applications, including other government contractors using it, or something that's a slightly you know, less extreme, but would basically tap a 1950-era law that said that you know, basically tell Anthropic, too bad, we're the U.S. military, we're going to use your platform however we want.
So Laura, if no deal is made, what impact will that have on both parties?
So this is really the question here is, will this 5 o'clock deadline stand? This is, you know, essentially an arbitrary deadline that the Pentagon set. There's no, you know, legal forcing action or anything. You know, they could continue to negotiate if the Pentagon asked. However, if the military were to say, look, you know, this is the deadline, and we're either going to take, you know, this extreme action of removing Anthropic from all government, military applications, that could have a huge impact both for Anthropic as well as for the military itself, because they have been using Claude for quite some time, and it's also, you know, other government contractors, places like Boeing, Lockheed have this embedded in their systems already.
Thank you so much, Laura. Bloomberg's Washington Deputy Bureau Chief, Laura Davison, and we'll come back to the story a little bit later in the hour also with Parmi Olsen from Bloomberg Opinion. Now, Netflix has dropped out of the battle to buy Warner Brothers, clearing the way for Paramount to clinch the deal. Let's bring in Manuel Baigorri, Bloomberg's deals reporter. Manuel, great to speak to you. So why has Netflix pulled out, and what does the deal mean for Paramount going forward?
And definitely, Francine, another chapter on this saga that has kept us so busy for the past few months, and Netflix walking away from the deal after Paramount obviously came with a knockout offer, $31 a share, and Warner Brothers, you know, concluded that it was a superior bid. Naturally, Netflix decided to stay disciplined, financially speaking, and also definitely will continue to invest in new shows and content going forward. Perhaps also will be in the lookout for other acquisition targets that may come, you know, in due course. But at the same time, for Paramount, I mean, they were the ones that kicked off the whole transaction months ago. Obviously, they had to battle an agreed deal between Netflix and Warner Brothers since December, but they came back very seriously with new offers, new addendums, sweeteners, and this final knockout bid. Obviously, now the question is how the regulatory approval path will continue over the coming weeks, months, and quarters. How smooth that will be remains to be seen.
Manuel, thanks so much. And Bloomberg's deals reporter, Manuel Baigorri. Now let's bring in Patrick Armstrong, Chief Investment Officer at Plurimi Wealth. He stays with us also for half an hour to try and unpack all of the big news that we have. So, Patrick, thank you so much for that. When you look at, so, you know, Anthropic for me is something bigger than just the story, because it kind of maybe puts some fault lines or the blueprint of what future contracts look like from all governments around the world. Am I reading it right?
I think you are, and I think it's a question we can't answer yet. There's so many unintended consequences when you start to use Claude and Anthropic things about where it leads to, how you rely on them, what the consequences are, and very big question, still very difficult to answer.
Yeah, and this goes, it goes kind of democracy, defense, values. It kind of goes to everything. As an investor, do you need to make a bet on that, or do you stay away from the sidelines, or do you just look at the technicalities of these companies?
So, because it's such a big question, and there's going to be so many twists in the road about where we get to when companies like Anthropic, OpenAI, when they really start to monetize and generate profits, that's a question that's too far off for me. Where I'm positioned is investing in all the equities that are getting the $100 billion that the hyperscalers are spending. So the high bandwidth memory stocks, Samsung, Hynix, Micron, I love those. Those are stocks that are up 300% over the last 12 months, but they're cheaper today than they were a year ago because earnings have gone up more than the share prices. Earnings forecasts have gone up. Energy suppliers, companies that build out the electric grid, even those kind of companies, as the hyperscalers are desperate for electricity. And it's high bandwidth memory, electricity, those are the bottlenecks. That's where there's extreme pricing power. So playing AI, but not on the long term, playing the beneficiaries today.
Patrick, I mean, how does it change our economies? Again, I was surprised. I mean, I wasn't surprised, but actually when you look at Block, which is Jack Dorsey's shop, and he gets rid of, half of his staff, their share price pre-market is up quite significantly. Again, does this translate into most companies? Does it translate into some of the smaller companies?
A company like Block and Dorsey's old company, Twitter, Elon did the same thing. He got rid of so much staff. Companies that really have business models where you probably can scale down the human component because it is so easily done with clever software and artificial intelligence. So it's definitely symptomatic of part of the world. I don't think every industry is going to be like that, but the market's rewarded this, and every company that's thinking maybe I can pull that lever as well to create a 20% gain in my equity value, it's going to be happening a lot, yeah.
Patrick, I also want to talk about the UK because the Prime Minister Keir Starmer's ruling Labour Party has lost a formerly safe seat in the UK Parliament, finishing third behind the Green Party and Reform UK. So let's bring in Rosa Prince from Bloomberg Opinion. Rosa, talk us through the significance of this. Is Keir Starmer's leadership now on the line?
Yeah, it really is. As you say, it's just one seat. He has 404 MPs, or he did until this morning, and so it shouldn't be a big deal, but actually it really is. And that's because this was a very safe seat for Labour. It was one with more than 50% of the vote at the general election just 18 months ago, and it really matters because of who that seat was lost to. The Greens won it, and that means that there is a threat to Labour, not just from the right, which we kind of knew about already from Nigel Farage's Reform UK party, but also now on the left. The Greens are not really talking that much about climate change and the climate crisis. They're really a socialist party. They talk about wealth taxes, about how billionaires are taking away people's wealth in other ways. And I think for Labour that's actually a kind of a crisis, because now you have Labour MPs coming out this morning saying both that we need to go to the left, and trade union leaders saying the same things. We need policies that actually are appealing to the same kind of voters that voted Green in this by-election. And also a problem for Keir Starmer himself, because those leadership mutterings that go on from time to time are only going to escalate this.
Rosa, let's also bring in Patrick Armstrong. Patrick, when you look at this, I mean, so there's a lot more pressure on Keir Starmer. I guess he may rethink his strategy. We may also see a leadership contest. Is there an assumption that Labour goes much more to the left, that the next Prime Minister will be much more to the left? And what does that mean for your investments in the
I think it's a risk. I think markets reward middle ground, centrist policies. They even like gridlock, but extremes are dangerous for markets if you're too far to the right or the left, and that's just where democracy is heading. The quick soundbite. If you're middle ground, it doesn't grab anyone's attention. You've got to be very far on one side or the other to attract attention. And short attention spans of people, social media, it really pushes politics that direction.
But does it change your view of investments in the UK? Or because, as you say, it's happening everywhere?
Well, it's happening everywhere, but some places rights are sort of gaining the ascendancy, some places left. I think the UK probably has killed the golden goose already to some extent in terms of pushing out high net worth people who aren't domiciled here but residing in London, pushing them to different domiciles. Anything that goes further is a big headwind in terms of the tax revenue the UK will be collecting. So you do shoot yourself in the foot by taxing wealth too much.
Rosa, where do you think this leaves Keir Starmer's government? So what are some of the conversations that they'll be having at Downing Street today?
Yeah, I think they will be in crisis mode again. We'll have to see if anyone actually launches that challenge against his leadership. Now, my own view is that the same kind of factors will come into play, which is that there isn't really a natural successor. So there's no one really who is the kind of crown prince across the water, apart from Andy Burnham, who you will remember had wanted to stand in this by-election, and Keir Starmer blocked him. He is the popular mayor of Manchester. A lot of Labour MPs saying he would have actually won this seat, but Keir Starmer couldn't afford to have that threat there in Parliament. So I think those conversations will be had, and if they can't get rid of him, I'm afraid I think for your other guest, they will be pushing him to go in a leftwards direction. There have been talk of wealth taxes already. So that might be one of the fallouts from this very interesting contest in the north of England.
Rosa, thank you so much. Our Bloomberg opinion columnist, Rosa Prince. Patrick, where do you see that the best value actually is? I know you look at sectors, you look at individual companies, but you also look at countries.
Our biggest overweights are Europe, but we also have a big overweight in Japan. Both those regions are cheaper than the global market because the U.S. just pulls up the global market averages. Like the banks in Europe still, they've had a great rally, but they're still cheap to me. Defense stocks in Europe have structural tailwinds behind them. And in Japan, it's a growth engine right now. The government's really putting in place policies combined with corporate governance, and I think the industrials, those kind of companies in Japan look very good.
Is there anything that you'd be selling right now? And I don't know whether, we'll talk about the Fed in a second, but also dollar dynamics and the fact that there's a bit of weakness in dollar. Does that change perspective for certain countries?
It's been a pretty flat dollar for the last 6 months. So over the last year, dollar's been incredibly weak for the last 6 months. It's actually pretty much stabilized. It's moved down slowly, and that's what I expect from here. I think we've had the big move in the dollar. Things that I'm short right now are companies that are very long duration. So I'm short KKR, I'm short SoftBank, I'm short Oracle, companies that are more aspirational, trying to get profits from AI. I'd rather own companies that are making the profits today.
Patrick, I mean, if dollar weakens, euro strengthens, how much of a concern is that for European exports, and actually how much of a concern is it for the ECB?
It's surprising, yeah. So France had some inflation that was a little higher than expected, despite the strong euro. I think the ECB is going to be very comfortable where they're at. They've got inflation roughly in line with where they want it to be. The economy is growing, not growing incredibly well, but I think it's a level that the ECB will be comfortable with. A very strong euro, a sharp move up like we had in the first 6 months of last year. I think the ECB would worry that that would be disinflationary, deflationary potentially, but the gradual grind up of the euro, I think they'll be happy with.
Okay, Patrick, thanks so much. Patrick Armstrong there from Plurimi Wealth stays with us. Guess what? We'll talk about credit next. You're dying to talk about credit and private credit and all that good stuff like the Fed. We'll look at the problems and fears affecting private credit next. This is Bloomberg.
up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, a private credit fund overseen by Apollo Global Management has cut its dividend and marked down the value of its assets amid signs of strains in parts of its loan book. Now, there are other indicators as well after non-bank finance from Market Finance Solutions collapsed in London. Now, still with me, Patrick Armstrong from Plurimi Wealth, and we're joined by Bloomberg's corporate finance czar, Neil Callanan. We also gave you an upgrade, Neil. Thank you so much for joining us. Look, Neil, first of all, where are we? Because you hear half of the big guys in some of the credit saying, like, look, it's not systemic, don't worry about it. There's going to be like bits and bobs, but it's nothing that would snowball. But actually, there's these pockets of concern that keep on cropping up every couple of days.
Absolutely, and it does feel like every day there's a new situation emerging. What this week shows in a way is that regulators got certain things right, but then there may be things to worry about going forward. So what we're seeing is a lot of lending that banks were encouraged to get out of. That's where the problems are emerging. And so regulators will be happy with that. But what people didn't think about is the companies that then went into that space, banks backed them, and that's where we're starting to see trouble emerge for some of the banks. So lending on lending is really a trend that's come out in the last week and the last few months, and that's certainly going to be worrying regulators going forward.
Yeah, but is it systemic? Do we know if it's systemic?
I think it's still far too early to say about that, but what concerns me to a certain extent is the lack of capital buffers that some of these lenders had, which means that the banks are more exposed to losses quicker. So in the case of the company in London, which is Market Financial Solutions, one of their related companies had a equity to lending of about 2%. A bank would have 5 to 6 to 7 times that amount. So when things go wrong, they go wrong very quickly, and losses are much higher as a result. And that's a concern going forward.
Patrick, what's your view on all of that? Again, it just makes, it doesn't touch markets that much. Equities are still, but it just means that everyone's a little bit more worried.
Yeah, well, there's been a wall of money chasing private credit because it's never marked to market. It just goes up, you get the carry, and you don't see any of the consequences of risk aversion that you do in liquid markets. So it's very attractive for investors to think I'm getting a carry and I don't suffer the pain. Excuse me. And when there is a wall of money chasing things, you do, when you're an asset gatherer who's then investing in the private credit, you do have to lower the quality of the things you're investing in because you have to put that money to work. That's why the money's coming into you. And then when there are little worries, you don't know how broad it is. Is it the sign of something? Is it a canary or is it a one-off? And there's always going to be one-offs in this kind of lending. But yeah, 2008, huge regulations put on banks, made them very safe. And then the vacuum created by where they couldn't lend, it's been swooped up by private credit, and it's much less regulated.
But is it a canary in the coal mine? I mean, I remember it was like there was a quirk, I think 2007, like August, it was a BNP Paribas fund, which everybody said, it's fine, it's August. And actually, that was the first sign that everybody missed. Yeah,
there's probably many canaries, so that one we remember, because there was a huge event after it. And you don't know if this canary is going to be one of those ones or not. In the next recession, this is going to be terrible. I don't think we're heading to a recession right now. I think we've still got fiscal stimulus. We've still got monetary stimulus. We've got big issues with software companies and had hundreds of billions of market cap disappear. And these companies in private credit have obviously seen their business models challenged. And if you're a small company producing software, you are at risk of completely being disrupted. So, yeah, it's definitely something to keep an eye on. I wouldn't view private credit as risk-free, I think, the way many investors did a year ago, maybe, anyway.
So, Neil, what is the team chasing in terms of potential, sectors where there could be more stress? Is it mainly, there was also an understanding, I think, at the beginning of the week, or at least I was told by big investors, that it's more of a U.S. problem. It doesn't feel like that.
No, but I think where people need to focus now is what areas of finance did the banks get out of, but then fund people. So trade receivables, consumer lending, buy now, pay later, specialized mortgage financing, and in the US, things like multifamily. That's where a lot of the problems are and where a lot of the problems will emerge. And it comes back to the banks through those lending firms, which aren't very experienced, many of them less than 10 years experience. And they had a great run, a golden era, and now that is being challenged. And not only is it being challenged in terms of the lending standards, but now once interest rates start to fall, their returns start to fall with them, because most of those loans are floating rate as well. So they're going to be challenged on both sides, but on the lending standards and on their funding side. And so they're going to be in for a tough period for the next 2-3 years.
Are there any concerns, and I don't know whether this impacts your world, Patrick, about also a lot of these, private markets in general being, sold to retailers?
It is, and yeah, ETFs on private credit funds, things like that are giving false liquidity to an illiquid underlying asset class. Pension funds just felt safe allocating more and more into private equity, no mark to market, and you do have speculative excess because you're never punished until you're really punished in less liquid markets. It looks like nothing's happening, then you have a massive fall, whereas in liquid markets you have a grind down sometimes.
So for you, what does that mean?
So I'm short duration. I just think what the Fed's going to do, what politics is doing, is unequivocally inflation, and that means steeper yield curves, wider credit spreads. Anything that doesn't have earnings today, I don't like. If you're a long duration bond, conventional bond, I'm not a big fan. Inflation-linked bonds, I think, are winning strategies. So yeah, the big answer is markets are really going to punish duration in equities and in bonds.
And this is what, across the board? US, Europe, UK, Asia, Japan?
Less so in Europe, because you've got a real credible central bank there. There's no politicization of the central bank. I think the Fed is at risk of being undermined by politics. Warsh is a totally credible chairman, but I think he's being politicized. I think him applying for the job, the Fed doesn't need to cut rates, but the Fed will be cutting rates.
This year?
Yeah.
How many times?
I think they'll cut twice, and I think Jerome Powell said transitory 6 to 8 times in every press conference in 2021. Warsh is going to say AI-driven productivity. It's going to be disinflationary. We have to cut no matter what because this is going to be disinflationary. I don't think it's going to be as true as it is, but that's the narrative he's going to have to create the credibility to justify the cuts. But I think quantitative tightening happens at the same time to get the rest of the Fed on board.
I mean, if we put the risk of a Fed policy mistake to one side, does 1 or 2 cuts from the Fed help some of these, private credit markets?
No, because they make super profits on the basis that interest rates are higher, and so because they're floating, it's the opposite. They're actually narrowing their profits going forward. For banks and mortgage lenders and things like that, it's probably decent news.
So there's no underlying lending that they could benefit from if the cuts that makes it cheaper.
I suppose their cost of funding could fall as well, but when you have so much nerves in the market at the moment, is that going to be the case? So they really are facing a double-edged sword at the moment. And if you're a private credit lender that needs to go raise money in the markets in the next year or so, you may be in for a bit of a shock in terms of what your spread is versus the rest of the market at the moment.
Neil, can you speak to also the fact, I mean, I remember when SVB happened, right, a lot of people in Europe said, well, it won't really affect us, and then something happened in the UK, but the regulator had it, again, in a better place than maybe the US. I mean, how big is the linkage between countries for a lot of these companies?
I mean, Europe is a very fragmented market, so most of the borrowers here generally aren't cross-border, but there certainly will be nerves around. There are accounting rules in Europe that allow you to spend a long time before you have to recognize losses. And then, of course, as we all know, sometimes things take a long time and then happen very quickly. And in particularly in Germany and countries like that, you're allowed to mark off what you think an asset is worth, etc. And so you're starting to see problems emerge with pension funds there, but that's a more widespread problem, and it will affect some of the corporates. Some of the problems have already been worked through, but there are definitely more to come.
It's so true. It's quiet, and then it just unravels very quickly. Thank you both for joining us. Patrick Armstrong, Chief Investment Officer at Plurimi Wealth and Bloomberg's Corporate Finance Tsar, Neil Callanan. Coming up, Veolia posts another year of record earnings. We'll be joined by the Chief Executive, Estelle Brachlianoff, next. This is Bloomberg.
The problem we've got as an industry is when the government's overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of the net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. It's deadline day in the safety dispute between the Pentagon and Anthropic, with the company's chief executive saying it cannot, quote, in good conscience agree to the latest request. Netflix says the bidding war for Warner Bros.